Hi everyone, this is Victor from the Fifth Person. At Fifth Person, we invest in great businesses, be it for dividend or capital gain. My job is to help retail investors to do the same so that they can grow their wealth safely and consistently over time. So over the years, we have been getting a lot of questions from our readers about investing, and we're going to be doing a series of videos to address all these questions, and hopefully it can be helpful to you and of course bring more clarity to you as an investor. Okay, so my first question I fear is, given a choice, should we choose cash or scrip dividend? So as a general rule of thumb for investor is that usually when the company is overvalued, we want to get cash dividend. If the company is undervalued, we want to get scrip dividend. But my personal take is that we should get cash dividend. Why? Is because if you were to get scrip dividend, right, you will end up with a lot of odd lots. And it's very hard to sell in the open market. Whereas if you were to get cash dividends, right, when you take the cash, right, you have many choices of what you're going to do with the cash. If the company is still undervalued, you can still take this cash and buy back into the company without getting odd lots. Okay, so now I hope you got more clarity on how you can choose between cash and scrip dividend. So let us move on to the second question. Are you comfortable to invest in companies that encounter 3 director resignation within a 2 years period? Definitely, I'm not comfortable with such company. Why? If the company director were to resign in a period of 10 years, just only one director resign is still okay. But if many directors resign between a 1 to 2 years period, right, then I got a concern with the company. That means there must be some issue with such company. Firstly, you need to find out the reason. If you can't find out the reason, I'll avoid such company. Okay, so avoid companies that have regular director resignation. Okay, so let's move on to the third question. What's the difference between REITs and business trusts? Which is better? So basically, the difference between REITs and business trusts, there's 3 things. The first thing is the structure, the second thing is the gearing, and the third thing is the distribution. Let's talk about the structure first. If you were to look at the structure of the REIT side, they basically have 2 entities. The manager that manages the operations and the trustee that owns the asset. Whereas if you were to look at business trust, right, they only have 1 entity that owns the assets and manage the operation. And let's move on to the gearing. For the REIT side, they have a gearing cap, a gearing limit, whereas business trust, there's no gearing limit, so they can take up as much loan as they want. And lastly is the distribution. So for the REITs, right, they have to pay out 90% of their taxable incomes to the investor, whereas the business trust, they got no limit on the number of payouts that they want to pay out to the investor. So between business trusts and REITs, right, I will choose REITs because in terms of structure and in terms of dividends, right, it's better to invest in REITs as compared to business trust. So that's it. I hope you enjoyed today's Q&A video. If you find this video to be useful, or if you know of someone else who can benefit from this video, please feel free to share with them. And likewise, if you have any other questions that you want to ask, just type in the comment box below so that we can pick the best one and answer them in the next few videos. So once again, this is Victor Chung, and I will see you soon.